There has grown in the last decade or so a kind of security called a derivative. There are 1.2 quadrillion dollars worth of derivatives in banks on the planet. Most of these derivatives, these securities, are bets on the direction of interest rates. That's all they are. B of A says the interest rate on Greek bonds is going up. Deutsche Bank says they're going down. They bet. That bet becomes a security. People bet on those bets. People bet on their bets, and there's this pyramid of these Vegas-like securities. I think somebody's going to stick a bubble in that world.
You mean a pin in the bubble, right? Yeah.
A pin in the bubble. Thank you. There are $227 trillion worth of derivatives in the major New York banks. The godfather of the global financial mafia, the Bank for International Settlements in Basel, Switzerland, who basically rules banking on this planet, basically structured something to protect the banks from being taken down by derivatives exposure, and that's called bail-ins. Bail-in means that if a bank is troubled and going bankrupt, they have the right to take your deposits and convert it to bank stock. Take your deposits and convert it to bank stock.
So if you have money in the bank, the bank can just take it and say, instead of your deposit account, you now own stock in our bank.
In our failing bank.
In our failing bank, yeah. Even if you didn't want to buy the stock in their failing bank.
That's right.
Yeah.
Yeah. So that's official policy in the EU. Canada adopted the policy a couple of years ago. And when you read the Dodd-Frank bill, it permits that in the United States. There's actually a memo online, people could go find it, written by the FDIC and the Bank of England jointly that explains how bail-in policy would work here.
Wow.
So I just, I tell your listeners, make sure you're in a strong bank. I encourage them not to bank with the big money center banks. Find a good regional bank, because the big money center banks are the ones full of derivatives. But that's what a bail-in is. It's there. It's my opinion that the Bank for International Settlements didn't do this for no reason. So I don't like to prognosticate as I like
prognosticate. Hey, don't pull a Joe Biden on me.
Bad news, but I do think the banking system in the United States is going to have some trouble.
Yeah. So let me ask you about the derivative thing. Just super quickly, we'll wrap it up here. So, I've long called derivatives, I like doing these folksy, simple things, right? I call a derivative the thing about the thing, okay? And so the interesting thing about derivatives is like any investment or any asset, there's always a counterparty. So if one person loses, another party wins. So my question is, those numbers with derivatives are obviously astonishing, right? They're insane numbers, right? The global GDP, right, just to give a comparison, is about 80 trillion a year or 100 trillion a year, I think now.
So about 100
yeah.
trillion.
And the US is like 22 trillion a year or something like that. So that's a comparison for how massively giant the derivatives market is. But okay, say it collapses. So someone will lose and someone will win. The chairs move around in the game of musical chairs, but does it really lead to such a disaster?
Here's the question. Can the loser afford to take the hit? JP Morgan Chase, Jason, the last time I looked, had about $50 trillion worth of derivatives exposure.
Wow.
The numbers are eye-watering. They're almost, you can't even think with them.
Yeah.
So I think if one bank takes a hit, you'll have something like 2008 where it will just spiral out of control.